What's up guys, this week we're gonna delve into the numbers about the property that I bought and I showed you the video last week. I'm gonna leave the link into the description and up here so you can take a tour around the property. But let's see how things look like. The purchase price of the property is $95,000. Now here I got a spreadsheet that's been sent from me from the people that I bought the property from. It says wholesale price $8,900, rehab cost $12,500, estimated cash to carry $15,000. But all in all, I'm gonna be out of pocket with about 10K, maybe 12, but the numbers came up a little bit lower. It's gonna be around 10 or 12. And we wanna make our assumption on that. And for easing the numbers, let's say that the property cost me 100K and I'm gonna leave 10 in it, so 110 is going to be the all-in number. The ARV from the property, underwritten value we have from another company, it's 131,000 and change, and we're going to take 130,000 as an example. And after I refinance, my loan would be 98,000. Let's call it 100. Okay, let's work with even numbers. This, it doesn't matter if we use the super exact number. Okay, property will be mortgaged out to $100,000. Well, it's going to be worth 130. That's the ARV, and I'm going to leave $10,000 in the property. And with those numbers, let's see what we got. So expected rent, as you heard my buddy Doug says into the video, we're going to aim for $1,100. If it doesn't work out, we're going to lower it down to $1,050. Let's take the conservative approach and say $1,000 in rent. I'm going to come to my favorite app, DealCheck. You can literally enter the address and the app will find the home. Now, as you can see with the loan we have assumes IO on 4.5%. Here, this is interest only. So there's a program, there's a product now that it's 4th-year mortgage, and the first 10 years you pay interest only. And in 10 years, you can do one of two things, basically. You can continue to pay 30-year normal mortgage with a normal amortization schedule, or you can just sell the property. Here on the right side, you can see that in 10 years with I believe it's 8% increase, annual rate of 8%, the property will be worth almost $220,000, and you can capitalize on that gain, and you can sell it and take, what is that, 90 grand worth of, $90,000 worth of profit. But again, in 10 years, the dollar's purchasing power will be lowered by, what is it, about 20% or so. So it's not really 90 grand. But we're going to talk about inflation in some other video. So this is one of the ways you can structure it today. 4-year interest only for the first 10. Or you can take a normal 30-year mortgage if you want. It's whatever you wanna do. If you get a 30-year mortgage, it's going to be principal pay down, where the tenant will pay down the property for you. But you're not gonna get as much cash flow from it. I don't know if I mentioned that $100,000 purchase price includes the cost of the property plus renovation, and $10,000 that comes from me is for closing costs and other fees and gap funding, which is basically, it's not 100% of the renovation cost, so I need to come up with some money for the renovation cost. So how we calculate cash on cash return? We take the net operating income, which is NOI, net operating income, which is the rent we receive minus the mortgage, minus, basically minus TIMR, taxes, insurance, management, maintenance, emergencies, and reserves. And whatever we have per month of that, multiply by 12, because it's a yearly basis, and we divide it by the cash invested. So here, if you look at the picture, we do have mortgage $376, property tax $44, insurance $75, vacancy $30, maintenance repairs $50, capex $50, and whatever PM means, honestly, I don't know what it is. From $1,000, we're gonna minus all of that, and we're gonna get a cash flow of $273.16. We're gonna multiply that by 12, and we got, why am I doing it? So I'm multiplying on my calculator, I already have it here. It's $3,277.90. And say the worst case scenario, I'm gonna invest $15,000. That's the worst case scenario. And how I think the example here, they took the same. It's 21.8% cash on cash, which is quite a lot. But let's not do this. Let's divide it by 10,000. Let's say on the lower end, I invest just $10,000. My cash on cash will be 32%, which is crazy insane. Let's see how much the cap rate is. I don't see the number here, but the cap rate is when you divide the NOI divided by the property's current market value. Current market value of the property will be $130,000, and we already know our NOI. It is our NOI, our net operating income, is 273 by 12 for the year is 3277, and we're going to divide that by $130,000. And we're going to get a 2.5% cap rate, which is not great, but the deal is designed to cash flow. And if I decide to opt in for the 4th-year mortgage, which I haven't decided yet, with the first 10 year to be interest only, so I can get more cash flow because I'm going to pay just the interest and I'm not going to pay any principal. That will basically increase my cash flow so I can either invest in another property, but not build that equity into this property. Maybe later on down the line, I can refinance and switch to a regular mortgage. We'll see what my strategy will be. Well, that's pretty much for today. There's nothing really, it's not really a mystery. It's a very cheap property. I'm gonna have a managing company. So that $273 a month will not be exactly $273 a month because the managing company wants 10% of the gross rent per month. So this number will be more like $100 less. But it's going to be a hands-off, and I can actually devote my time to do whatever the investors do. Invest, look for new properties, look for new deals, look for new opportunities, instead of going to, change toilets and unclog pipes. But that's it for today, guys. Thank you very much for watching. If you don't mind, smash the like and subscribe button if you stick to this part of the video. See you next time. Keep hustling and invest your money wisely.